could be no better way to begin our conference than by talking to Sir Ronald Cohen. Sir Ronald, thank you very much for joining us. He was an influential pioneer of private equity as one of the founders of Apax Partners in 1972, and later helped to set up the British Venture Capital Association. But for the past 20 years, he's been involved in another movement, impact investing. This is the idea that investors, while still being investors and making a return, can also set out to improve conditions in society or the environment, not in a general or vague way, but in a very specific, targeted way that achieves measurable results. This might be creating employment in a disadvantaged community, improving girls' access to education, or working with ex-offenders to help them find jobs. The scope is endless. Sir Ronald chairs the Global Steering Group on Impact Investment, one of the foremost bodies in the field, and the Portland Trust, which aims to stimulate economic growth in Palestine. Impact investing has grown into a market now estimated at $715 billion, and there's clearly huge potential for it to grow further. But is there a deeper lesson than that? If impact investors can make a positive impact while still earning a profit, can capitalism as a whole do that? Could all the big investment firms and companies start thinking like impact investors? So I just remind the audience that they're more than welcome to post questions using the Hub chat function, which we'll try to answer at the end in our live Q&A. So, Sir Ronald, the coronavirus pandemic is obviously a unique crisis in the post-war world. Lots of people think it has jolted public opinion and politics so much that attitudes will change permanently, enough to change the way the economies run. Do you believe that, or is it just wishful thinking?
No, I very firmly believe that, John, and it's wonderful to be here with you and everyone at the SRI forum to talk about this. I think we're at a historic crossroads, similar to 1929. After 1929, investors sat up and started realizing that they had been investing in companies without having proper transparency on the profits they made. In those days, as you know, every company could pick its own accounting principles and there were no auditors to verify the numbers. I think we are at the same crossroad, but this time it's about impact transparency. The breakthroughs that we have made through technology and big data are enabling us to measure the impact that companies create through their products, their employment, and their operations on people and planet in a more dependable way than we measure risk, and pretty well as accurate as the way in which we measure profit. And I'll talk about the breakthrough at Harvard Business School, which has put online, open source for everybody to see, under the Impact Weighted Accounts Initiative, the environmental damage created by 1,800 companies. And I'll be happy to answer your questions about that. But to answer your first question, I think we need to do for impact transparency now what we did for profit transparency in 1933, 4 years after the crash. Mandate that companies must publish impact-weighted accounts that reflect their performance in terms of profitability, but also in terms of impact.
Thank you. And this has to be brought about somehow. We need, some sort of movement. And obviously, the main actors in society are, broadly speaking, government, the public itself, and the business sector. So, and obviously the coronavirus seems to be shaking up the relationship between those three, with different expectations being created on the part of each of those three about how the others will behave. So what do you expect to come out of this sort of maelstrom of reordering? And how could the movement you described sort of emerge from that?
So if we look at what's been happening over the last 2 decades or so, we've seen consumers begin to shun the products of companies whose values they don't share. We've seen young people refuse to work for certain types of companies that similarly don't share their values. And we've seen massive investment go to environmental, social, and governance investing, as well as impact investing. So the figures this year, for the first 6 months of the year, are the 20 trillion flowed to ESG investment. So that would mean 40 trillion over the year. Last year was 30 trillion. That's equivalent to nearly half, 40 trillion of professionally managed assets in the world. So it's well beyond tipping point. And the problem we have there is that those wishing to achieve impact as well as profit through their investment don't have the transparency they need to be able to make discriminating choices. Alongside that, as you correctly said, you have impact investment, which is defined as having that intention to create impact, but also the dependable measurement of the impact created. And you can't manage what you don't measure, and that's the idea behind impact investment. So there's 40 trillion basically putting pressure on companies to change their behavior. It's not very effective today because we don't have the transparency, and we can transform that 40 trillion of ESG, which is investment in public markets, in bonds, green bonds, blue bonds, brown bonds, social bonds, investment in private asset classes, impact private equity, impact venture capital, impact real estate, impact infrastructure. So investors are going to be the major force. Now, you're correct in saying that we need government to mandate the publication of impact-weighted accounts in the same way that we mandated gap accounting, or the US mandated gap accounting in 33. But governments don't tend to lead very boldly. They tend to follow, you know, and so it needs to come from every direction. I think all of our viewers can put pressure on government to act. And the investor voice, the popular voice of consumers and employees are what is going to get us to this change.
Thank you. So at the moment, capital markets are all about money. Everything's measured in money and valued in money. Investors might think long or short term, but they're hoping to make a good risk-adjusted return, essentially. And ESG investing, many would argue, means using a fuller set of information to seek out that return.
Yeah.
So do you think that kind of thinking and using money as a metric is adequate?
I think it can certainly be adequate. Let me give you an example. If you look at the 1800 company data set at the Harvard Business School, and you analyze it, you begin to realize that 15% of the companies in that data set, more than 250 companies, are delivering more environmental damage in dollars than they are profit. Okay? A third of these companies, more than 500 companies, are delivering 25% damage relative to their profit. Now, if you begin to get impact-weighted accounts where the positive and negative environmental impacts from operations and the product impact on people and planet make their way into financial accounts, you can see how impact-weighted earnings per share begin to be the basis for valuing companies. The data set also shows a very interesting trend. There is already a correlation between greater pollution in some sectors and lower valuations for companies. And if you look at specific companies, you take a company like ExxonMobil, which delivers $39 billion of environmental damage from its operations a year. compared with Shell's $13 billion of damage and BP's 8. Even if you believe that you should have fossil fuel investments in your portfolio, which I don't, you'd have to be perverse to invest in ExxonMobil, because you'd have to realize that the risk of investing in this company is much higher than its other two competitors. It's more likely to be regulated, taxed, and lose talent, and so on and so forth. So by providing transparency in a monetized way, we can set off positive and negative impacts on people and on planet. And we can begin to separate companies out into two buckets. Those that have great profitability and are net impact positive, and those that are similarly profitable and net impact negative. And we will begin to analyze then what the future growth of these companies is likely to look at, given the advantages of those that are not polluting and not creating social issues in terms of regulatory taxation risk and risk of losing talent and so forth.
Thank you. So I think you're beginning to describe what impact-weighted accounting might be like. And you get the example of the oil companies is very interesting. But obviously, you know, real-world impacts, whether environmental or social, are much more complex than anything in the financial world. They're far more multifaceted, and they involve you know, difficult measurements, but also trade-offs, you know, value judgments. Like, you know, how do you weigh up the necessity of creating employment with environmental damage, or how do you compare, you know, biodiversity versus climate?
So it becomes obvious when you look at the papers that are posted on the Harvard Business School site that actually this reaction you've just described just comes from the fact that we haven't actually addressed it in a methodical way. Let's take some of the more complex issues you've been referring to. So we can all measure CO2 emissions, and there's plenty of analysis around on how much a ton of CO2 causes in terms of damage. But what about diversity? Lack of diversity in the workforce? Well, if you begin to compare which technology enables us to do and big data, the demographics around the company's facilities with the demographics within the company, and you look at the missing people from certain communities at every echelon of a company, and you apply their remuneration levels to that. You take a company like Intel, and that exercise reduces a $7 billion wage bill, which should have all been positive impact, by half, because of lack of diversity in the workforce, because of differences in pay and benefits and so on and so forth. So you can actually measure the social cost of diversity. And then a more general point, John. Judgment pervades the whole of financial accounting. We have judgments about how you recognize the revenues of a software company. We have judgments about how you recognize leases on the balance sheet. Every month there are changes in accounting policy. Now, we've had 9 decades to perfect our financial accounting system. I see this impact accounting system similarly as a live system, constantly being refined.
Okay, so I'm interested to ask, you're giving us a good picture of what it might be like. Okay, so how nearly ready is it? Right? How much of this architecture and work has been done, and how much remains to be done? So
I believe that government should now be pushing for companies 2 years from now to start publishing impact-weighted accounts. The effort at Harvard Business School, which I'm privileged to chair, and which is led by a professor of accounting called George Serafim, will add to environmental impact next year employment and product impact. We will then have a complete picture of the impact that companies create. The technology exists, the data exists within companies. The figures you're going to see on the Harvard Business School site are all based on public information that companies have provided. But if companies provide it from inside on an audited basis, obviously it'll give us the reliability we need. And so the answer is it's ready for implementation 2 years from now. Mm. And it was very interesting that yesterday, the International Accounting Body, IFAC, came out with a major declaration that we need to move to sustainability accounting. Well, the method exists now.
Mm. And is this, I mean, people will have heard of the Sustainability Accounting Standards Board, for example, and there are also, of course, other reporting schemes such as the Carbon Disclosure Project and the GRI. So is this completely separate from that, or connected?
No. The work of SASB and GRI and others is foundational for the work at Harvard Business School. It's on that data that the impact-weighted accounts are prepared. And the way I like to describe it, John, is for some decades now, there have been 150 or more efforts to measure impact across the world. And they have been rather like fashioning the pieces of a puzzle without being sure what the picture on the puzzle is. And impact-weighted accounts give the picture, because we need to have something that investors can use easily, to which they can apply the tools of financial analysis that they are used to applying. PE ratios, Sortino ratios, Sharpe ratios, and so on. And so the destination can't be a rating system, which is where a lot of effort started. It has to be the measurement and the monetization of impact and their reflection through regular financial accounts.
Thank you. I'd like to ask you, obviously you worked at Apax for a long time. You're a true private equity investor, by training. And many of the people listening are classically trained bankers, investors, treasurers of companies, and so on. Now, do you believe that what you are describing and the way that you approach capital markets now is the result of a sort of conversion in which you've become a different sort of financial person? Or is it really the same?
It's actually the same, but you're playing the game differently. You're trying to achieve the best returns that you can. Now you begin to realize that impact is driving financial markets, driving consumers, driving employment, driving entrepreneurship, that new business models are being defined, Tesla being an example, that are going to disrupt the business models of competitors because they're bringing impact, in the case of Tesla, environmental damage reduction, to the center of a business model, which is going to be more successful than traditional ones. In fact, we see the whole of the automobile industry following Tesla now with electric vehicles and hybrid vehicles, as you know. So I believe that the new efficient frontier of investment is going to be more favorable with risk-return impact optimization than risk-return optimization, both because of the reduction of risk to which we've referred, but also because when you begin to look at opportunities, investment opportunities for companies and for investors in companies, with an impact lens on, you discover new sets of opportunities for populations that have been underserved, typically, at lower price points that you otherwise would not have discovered. And if you have time, I'm very glad to give you a very powerful example of this, but you may have other questions.
Well, go on, and then we'll move, I think, to the question and answer. But do give us your example.
So, if I could give you an enlightening example, there's a company in Israel called Mobileye, where the founders developed deep artificial intelligence for driverless cars and sold the company out for $15 billion to Intel. So hugely talented entrepreneurs. The aunt of one of the founders was going blind, and the founder decided to create a pair of spectacles for the blind, and did so. It's a company called Orcam. It's raised $100 million. Its last round was $600 million. It whispers into the ear of the wearer the page of the book they're holding, or the envelope, the address on the envelope they're holding, or the banknote they're holding. Unbelievable. 35 million blind people in the world, 250 million visually impaired people. Now, if you put an impact lens on and you ask yourself the question, how can my technology help the greatest number of people in the world, you get a surprising answer. What if you gave these spectacles to the 800 million illiterate adults in the world? What would that do for their lives and their livelihoods, for their economies, or even for the world economy, to bring 800 million people from being unable to read to reading? So I'm a firm believer, and as you say, I started out in venture capital and then added private equity. I'm a hard-nosed a financial investor. My returns for 15 years were 30% net. So I know what I'm talking about when I talk about investment. So this isn't pie in the sky. I believe we will deliver better returns by optimizing risk-return impact than just risk-return. And returns today on ESG investing for this year have outperformed other investments. So we're beginning to get evidence of that.
Thank you. Well, I'd like to ask the audience now to click on the link which you see in your hub screen to the call that we'll be using to do the Q&A. So that means you can ask questions to Sir Ronald if you haven't already posted one in the chat function. So please click on that link and join us for the Q&A now. Sir Ronald, thank you for joining us for some questions from the audience. I think people enjoyed your talk very much, and I've got a question to ask you, which is, might there be a problem to do with different countries' value judgments? For example, different countries will have different standards and priorities when it comes to sustainability, and if those are going to be factored into impact accounting, how can that be done?
So the purpose here is, like financial accounting, to give an objective view, John, of what the impact is that a company delivers. So whether you're measuring diversity or whether you're measuring carbon emissions, there are objective measures and they're audited. Then comes the question of how do you value a ton of CO2, for example. And an impact accounting board will agree certain values for these. So to the extent that there are differences in countries and standards of living and so on and so forth, accounting policies would be set down to cope with that. But the aim is to provide an objective view, and then to leave government to provide incentives if it wants to encourage certain types of behavior, rather than to provide incentives through the accounting system.
Okay, thank you. And another question which is sort of related to that is, if, let's take the example of a consumer goods company, right? Now they produce, a lot of these companies talk about their impacts in terms of helping people keep clean, right? And that obviously is a good thing, but then it involves pouring a lot of detergent into the oceans, right? Now, these are the sorts of things which I think it's a bit difficult to imagine a board having to sort of weigh up the pros and cons. And I wonder whether it would be better to just concentrate on reporting the factual impacts.
Well, this is a factual impact. If you look at a car company, to take a similar example, there are two levels of environmental damage caused by a car company, at least two. One is in the production of the car. So if you look at different car companies, you will see that their operating footprint, environmental footprint, differs hugely, whether you're dealing with Mercedes-Benz, which is better performing, or General Motors, which is performing much less well. There's then a second level of environmental emission, which is also measured, which is the emissions from the cars that are actually manufactured. Okay? Now, similarly, if you take a detergent company, you will have to assess what the advantage in terms of health improvement is, and you will have to assess the environmental damage that is caused from all this detergent ending up in effluent. So, you know, we have today a lot of science around calculating the costs of environmental damages of this kind, water usage and so on. And if you go to the Harvard Business School website and look at the impact weighted accounts initiative, you will see there the environmental costs created by 1,800 companies, and you will be able to read reports about the methodology that has been used. And next year we'll be adding to that the impact of employment and the impact of products, such as the ones that you've just raised.
Thank you. Now I'm going to tell the audience that as it's 2 o'clock, the first panel discussion is starting. So if you want to join at the start of that, please click on that. But as we've got Sir Ronald with us, there's one more question which I'd like to ask, if that's okay, which is, you know, somebody's asking, well, the infrastructure's there. It sounds like, you know, a lot of the work has been done. And the desire is there among certain capital market participants. But the questioner is saying, well, with his pessimistic hat on, what could go wrong, right? What are you worried about?
I'm worried about government taking too long to act, about these concerns that we hear about not heaping additional obligations on businesses, winning the argument. The additional work that is involves a small amount of cost, but we have the right to know what impact companies are creating. And from the perspective of government, the cost of accounting for impact is a fraction, as you will see on the Harvard Business School website when you look at the environmental damage being caused, an infinitesimal fraction of the environmental damage that is being caused, a lot of which has to be cleaned up by government. So if you're talking of effluent in our rivers or whatever, government is actually spending money to do this. So that's what I'm worried about, that instead of viewing it, government viewing it as an opportunity to bring businesses and investors to its side in bringing solutions to the big social and environmental challenges we face, instead of that, we're going to get into big businesses pushing back on providing this transparency, and government will not be bold enough to impose it in the way that it did in 1933 with generally accepted accounting principles, which gave us transparency on profit.
Well, thank you very much. Sir Ronald, it's been fantastic having you talk to us. I think it's very rare that we actually hear something that's actually encouraging and cheerful in the world of ESG. People talk a lot about innovation. This is truly an innovation of a real magnitude that you're talking about. Whether it can be brought in, we don't know yet, but it's certainly a fascinating new thing for market participants to aim towards. So thank you very much indeed for sharing your thoughts with us.
Thank you, John. And it can be brought in, and we must have the will to bring it in. So each one of us on this call should push governments, companies, investors to ask for this transparency. Thank you.
Thank you so much, Sir Ronald.
Thank you. Goodbye.